Good evening, everyone. Welcome to TWI. TWI stands for the Wealth Institute. TWI is an online community of people who seek a better financial outcome in their lives. TWI hopes to achieve this by financial literacy and other peer-based mechanisms to help those who partake of our meetings and trainings become better financially and have more financially rewarding lives. Okay, so today, in line with our promise, we're going to be having an investors and investment masterclass, right? So we're going to go right into the subject matter. Who is an investor? An investor is a person or organization that puts money into financial schemes or property with the expectation of achieving a profit. So an investor can be an individual, can be a group of persons, can be an organization called institutional investors or a corporation that puts money into something, into a venture with the hope of making a profit. So there can be no investment, particularly in the business sense, particularly in the enterprise sense, without an expectation of making a profit. All right, I think that should be very well understood. A person or other entity, such as a firm or mutual fund, who commits capital with the expectation of receiving financial returns, that's another definition of an investor. All right, committing funds, committing capital with a view to earning financial returns. To put it very simply, I have 1,000 naira. I commit 1,000 naira to a particular vehicle, if I'll use that word, because investments are carried out through different investment vehicles, which we are going to be looking at in the course of today's session. So I put that money into that vehicle and I hope to make 200 naira in return. If I do that, I am an investor. So you commit money towards something, into a scheme, all right, and you are expecting your principal and an accumulated profit or interest on that principal. If you do that, you're an investor. So investing is as simple as that. An investor is a risk taker. An investor is someone that takes risks. We have different kinds of risks. You have mitigated risks, you have calculated risks, and then you have the terrible risk takers who don't evaluate things before they take the risks. An investor is not a careless person. An investor is someone who takes mitigated risks. When we talk about mitigation, we're talking about doing things to ensure that that injection of money will certainly return financial profit. That's what we call mitigation. Mitigation is an English word, all right? An investor is a knowledgeable person. You cannot be an investor if you don't have knowledge of what you are investing in. An investor is a knowledgeable person. What sets the very successful investors from the average investor is the amount of knowledge they have about the scheme they are committing money to. So investors are very knowledgeable people. They know their onions. They understand the subject matter they are investing in, because one of the things we learn in investment, the sage of Omaha, Warren Buffett, there's a statement. He has a popular phrase he likes to use when he talks about investing is never lose money. You know, it's something that he has held on to for many years, and he teaches it and has taught it over the years. And it's something I've also picked up in investing. Always have the mind never to lose money. Then the question now begs, if I'm not intent on losing money, then why do I invest? If I am not intent on trying to make money, then I should not be afraid of losing money. You know, there's this mindset that if you're going to take the risk to make money, then you should also not be afraid to lose money. Yes, the uncertainty is there. That is where knowledge comes in. So the investor acquires the knowledge that helps him to invest in a healthy manner, in a manner that he never loses his money. I think that point needs to be driven home. All right. And then an investor is someone that uses investment and market analysis data to build investment strategies. So investors use market analysis data. They use those pieces of information, to make and develop their investment strategies. I give you an example. We are going to invest in the capital market, in the stock market, for instance. You need to have data from from the companies you're going to be investing in. You need to understand their balance sheet. You need to understand their earnings per share. You need to understand their EBITDA. These are very important ratios you need to look at. You need to look at their balance sheets, their profit and loss account. You need to know whether the value of the share, the market price of the share, is lower than the intrinsic value of that stock. These are matters that we're going to be delving into in the course of time. All right, so that's who an investor is. So I want to look at the next important matter, which are investment vehicles. Like I said when we were starting, you invest using investment vehicles. An investment vehicle is a means or medium through which investments are made. Those mediums through which investments are made are called investment vehicles. And we have quite a lot of them, okay? And we're going to be running through some of them very quickly. So you talk about the stocks, the equities, all right? Equities are a very profound investment vehicle. The richest people in the world own equities. They own equities. They own companies that people want to buy into. As we shall see in the course of this discussion, when we start talking about the types of investors, the wealthiest people in the world start companies, grow those companies to the point that the public wants to own a share in such companies. So when you're talking about people like Bill Gates of Microsoft, you're talking about Mark Zuckerberg of Meta, you're talking about Amazon, Jeff Bezos, you're talking about Elon Musk, Tesla, SpaceX. These are investors that build companies so much. Those companies became so valuable that everybody around the world wants to own a share in those companies because they are very, very successful companies, and they pay very good returns for those who put their money there. So when we talk about stocks, there are two ways to play around it. It's either you're buying into a company somebody has built, or you have built your own company to the point where the public is willing to buy into your company. So stocks are very important as investment vehicles. They're also called equities, all right? Then you talk about bonds. Bonds are debt instruments. So bonds can be issued by governments, by corporations. So bonds they are called fixed income instruments, all right? The income is fixed because you earn a predetermined amount, usually on a quarterly basis. Let's say you invest like a 20,000 naira in a bond, like the recent FGM bonds, I think with as low as, because they're opening it up to the retail investors, with as low as 40, 50,000 naira, you can buy those FGM bonds. Now, every quarter, they pay you a certain percentage as interest. And then at the end of the tenure of the bond, you get back your principal. But over time, you would have gotten your interests. And usually those interests are paid quarterly. We're speaking to a Nigerian audience, a likely Nigerian audience. So bonds are debt instruments. The federal government recently, through the debt management office, opened up the bond market to retail investors. So with a little sum of money, you don't need tons of money to be able to invest in the federal government bonds. There are other bonds like the Sukuk bonds that the federal government issued that was used in building a lot of roads in Nigeria, developing infrastructure. All right. So you can actually get these bonds, all right, and earn passive income using these bonds, these instruments. If you want to know more about that, we'll be glad to guide you through the process. All right. That's why TWI is here. All right. The next investment vehicle we'd like to talk about commodities. All right. So when we talk about commodities, we're talking about tangible things, things like agricultural products, things like precious metals, precious stones. They are commodities that people invest in. Let me give you an example. People are investing in beans. People are investing in corn. People are buying corn and storing corn because at a certain season, this is harvest period. Just some people are still harvesting. Most people have harvested. People are storing these grains. Now there are companies in Nigeria that do very well in selling these grains. You can sell these grains on their platforms and make good money. Okay, so this is another investment window. Then the other part is I talked about precious metals, precious stones. Precious metals like gold, like silver, precious stones like diamonds, like emerald, and all kinds of precious stones, onyx and the likes. There's a global market for some of these precious metals. There are trading platforms where you can trade in these commodities. Crude oil is one of those, but again, that's for rather big investors, what people you call accredited investors. So this is another vehicle for investment. And then we'll look quickly at the next one, mutual funds. Mutual funds are an aggregation of funds by people, and then a particular financial institution helps them to invest those funds. So the reason they are called mutual funds is they are a conglomeration of smaller amounts of money pulled together. It's somewhat like crowdfunding. It's not exactly crowdfunding, right? But it's usually handled by asset managers. By the grace of God, I do some mutual funds myself. So there are so many mutual fund agencies in Nigeria. So we'll be glad to walk you through how to do that as well. So mutual funds, they also pay quarterly dividends, and then they offer capital appreciation, and they offer quarterly payments as you invest in them. And of course, they pay you to the extent of your risk appetite, okay, your risk tolerance. We're going to talk about risk tolerance further down because you can't talk about investment without talking about risk. All right. And then the next vehicle we want to look at is what we call exchange traded funds. Now, most of these exchange traded funds can also be run by mutual funds, okay? The agency that manages the mutual funds I currently do also manages exchange traded funds. Now, when we say exchange traded funds, they aggregate money from small retail investors and they invest these monies in the capital market on behalf of those retail investors. That's why they're called exchange traded funds. So these are funds that are specifically invested, usually in the capital market, all right? Sometimes in the money market, depending on the scope of the operations. And you have a lot of these asset management companies, quite a lot. You have Norrin Berger, you have Stanbic IBTC asset management companies, and so many others, all right? Then you have the next investment vehicle we want to talk about retirement plans, like your pension plans. It's very good to invest in pension. A lot of people who work in the civil service participate in the contributory pension schemes held by the federal government, some state governments. But we encourage private business owners to also have a pension plan for themselves, for their employees. It's an investment vehicle. Why? Because you're putting aside money that will bring return on investment later on. Now, those pension fund administrators, what they do when these workers pay these monies to them, they take these monies and invest it on behalf of those workers, such that at the maturity date, when those people retire, they are now entitled, usually age 50 for most people, when you get to, I think, age 60 or age 50, depending on the PFA you work with, you now access those funds, all right? And you should have come back with some increments in value, all right? And then the last vehicle, there are several vehicles. This is not exhaustible, but for the purposes of this session, the last one we're going to talk about is real estate. Investing in real estate is very, very good. And it has so many sides to it. You have what is called real estate syndication. You have real estate for just rental income, and you have real estate for capital appreciation, and then you have just mere land banking. All right, you buy a piece of land, you allow the area where you bought the land to develop, the value appreciates, and then you sell it off if you want to sell it off. All right. I remember someone telling me how he had opportunities to buy a plot of land in Abuja in 1991. The land sold for, I think, 20 or 30,000 naira at the time in Abuja. Then, about 20 years down the line, that same plot of land was selling for almost 500 million. Something he had on a platter of gold for 20,000 naira in 1991. Probably 10, 15 years after, the land had appreciated to as much as 500 million. And the person was telling me that as a sort of regret, he wished he had made that investment at that time, So we hope that nobody attending tonight's meeting will have such regrets going forward. All right, that's why we're here. Investment vehicles, second part of the investment vehicles discussion. So investors typically generate returns by deploying capital as either equity or debt investments. All right. The whole essence of investing is to generate returns. It's very important to know that. We said that when we started the definition, is to generate returns. All right. Returns on investment. It's called ROI. Okay. When we talk about equity investment, the example of equity investment we talk about is the investment in stocks. All right. When you do an equity investment, you have a part ownership in the company. All right. You become a shareholder. You own a piece of the company. Now, this ownership of the company would make you receive dividends. All right. So every year, the company pays dividends to all her shareholders. All right. So dividends, usually you have what is called year-end dividends, or you have some companies pay interim dividends, depending on how well they did financially during a financial year. The second aspect of the investments I talked about is what we call the debt investment. Okay. Now this can be in the form of bonds, like we talked about earlier. I told you that bonds they are debt instruments, usually issued by governments or some corporations that want to raise money. Okay, so state governments, federal governments, states like Lagos state government have issued bonds in the stock market. States like Kaduna State, went to the capital market to issue bonds to raise money for infrastructure and all of that. And they pay returns. The bonds are not for, you buy those bonds. When you buy a bond issued by a government, it's as if you are lending money to that government. All right. And they pay you returns on a quarterly basis. And then your capital that you have invested also remains intact. Okay. The only challenge I would say with bonds is that the income is fixed. It's not like stocks that the prices can go up and then your investment goes up in value. All right. With bonds, your investment is fixed. The income on your investment is fixed. All right. But it offers some measure of profitability, which is very, very good and encouraged. So very quickly, we want to look at types of investors. Okay. Now, investors may be classified based on the following. Now, this is, like I said, is not exhaustive at the start. Some of the things we're going to be sharing, and most of the things we'll be sharing in this session are not exhaustive, but they are very significant for your aspiration towards being successful in investments. Okay. The first criteria for classifying investors is the capital available for investment. Okay. So you grade investors based on how much money they have to invest. All right. So to that extent, you have what you call retail investors. Retail investors are those that have small amounts of money. And my take is that many of the people who might be listening to us tonight will fall under that category, retail investors. You have small amounts of money, 500,000, 100,000, 50,000, 100,000, 200,000. You're a retail investor. You're a retail investor. A million, 2 million, 5 million. You're a retail investor. Okay. And then you have corporations. Those ones invest large amounts of money. You have institutional investors, invest millions of dollars. I think it was sometime last year or early this year, Fidelity Bank received major investment from a US venture capital company. They invested several $1 million and acquired, I think about is it 2 billion, 3 billion shares of Fidelity Bank. That's an example of an institutional investor. The next classification is based on the investment style. All right, investors can be categorized based on their style of investment. Okay, so an investor can be active, or an investor can be passive. As the words connote in English, when you say someone is passive, it means the person is not giving all his time to it. They have other things they are doing, so they just do it passively. All right. So in the stock market, for instance, you have a lot of passive investors. They don't follow the trends in the market. They don't check. They don't read the stock market reports. They don't watch the stock market news on channels or Arise TV. They depend on their stockbrokers or their financial advisors. Which share is doing well now? And this share is doing well. Oh yeah, take 100,000 naira, buy me shares of this company. All right, they are passive. They are not taking direct control of their investment. That's one investment style. The other one is you can be active. You can monitor these things yourself. All right, you follow the news, you buy newspapers, you read, you follow the news, you buy newspapers, you read the reports, you check the ratios. There are so many indices to look at before you invest in a company. You check the board of directors. You're evaluating things yourself. You have the knowledge. You have the skill sets to determine which company to buy, which company you shouldn't buy, and when to buy, when to sell, and all of that. So that's one aspect of the style. All right. Another aspect to the style is whether you're investing short term or you're investing long term. All right. Some people invest short term. All right. They buy and they sell when the price goes up. There are those that buy and hold. All right. They buy and hope that the share price grows over a long period of time. There are stocks we call growth stocks. All right. But it takes some level of knowledge to be able to know which stock and growth stocks. We are hopeful that in the course of this series, we'll be able to go into all of that, to teach you and to make you understand what a growth stock is, what a penny stock is, which stock you can invest in now, and the value can grow in the next 5 years, in the next 10 years, and things like that. I remember a few years ago, Ukomu Oil and Presco, they were like penny stocks in Nigeria about 9, 10 years ago. Today, Presco and Okumu Oil they are very big stocks. Okay, so those who invested in Okumu Oil back in the day, today I'm sure they are smiling to the bank. All right, and then another area or another means of classifying investors is through their risk tolerance. All right, so people have different risk tolerance abilities, right? Some people are very averse to risk. In fact, I remember when I was going to do my mutual funds, the asset management company, they made a statement in the form that they gave us to fill. And they said, know that when the risk is higher, the return on investment is also higher. When the risk is lower, the return on investment is also lower. That's a very fundamental rule in investing. Okay, so one of the ways to invest smartly is to have knowledge to the point that investment or investing no longer seems so risky to you. You understand what needs to be done as far as investing is concerned, so that there's no risk to you as such in your investment decisions. I hope that is well understood. So the investor who is afraid, who is very afraid of taking risks, is an average investor. All right. And the reason he's an average investor is because he has not taken the time to acquire the knowledge he should have about investing. And then the investors who are very tolerant of risk are called the accredited investors. They are the sophisticated investors. They understand what needs to be done. They understand what I's they need to dot and what T's they need to cross so that their investments are safe and secure. All right. Now, I want to go to a very important aspect, investment planning. Somebody said that if you fail to plan, you've planned to fail. All right. There is no success that can be achieved without planning. The same thing goes with investing. The same thing goes with investment. Successful investors have a plan for their investment. All right. So you need to spend time, take your time before you go into investing. You need to take the time to ask yourself critical questions. All right. Spend time to think about where you are now, and then ask yourself, where do I want to be once I start investing? How far do I want to go? What are my expectations? What are the kind of returns I want to have? What kind of life do you want to have? All right. And these are things you need to do privately. You don't do it with your friends. You don't do it with your family. You do it privately. You need to ask yourself critical questions. What do I want out of my life? What kind of financial future do I desire? That is very important. You need to do that analysis. The next thing that needs to happen in your investment planning is you need to have a financial advisor or belong to a peer group of like minds, particularly people who have superior knowledge to what you have. I always advise people, don't go into investing if you don't have someone who has gone ahead of you in the game of investing. It's dangerous. Why? Because one of the keys to success in investing and investment is knowledge. So having an advisor or belonging to a peer group of knowledgeable people, successful investors, is that it will help you avoid the mistakes. There are so many pitfalls in investing. I remember when the consolidation happened in 2005, when Chukwuma Soludo was the CBN governor. A lot of banks went to the market. People were buying shares because they saw their friends buying shares. They didn't bother to ask critical questions. Why am I buying shares? They were just buying shares because everybody was buying shares. And unfortunately, in 2008, the financial crisis hit the world and Nigeria was affected. And many of those people that invested in those shares, they lost money because those shares plummeted. So it's important to have a group, have a financial advisor, or where you can't get a financial advisor, belong to a peer group. And this is where TWI comes in. All right. So TWI is a community of people. By grace of God, some of us invest in the stock market, and I'm sure there are other persons who are part of TWI who are also investing in the stock market. So by belonging to this community, you can learn and gain valuable insights as to how you can succeed in the game of investing in the stock market. Another aspect of investment planning is insurance. All right. It's very important that you insure your investments. Very, very important. You should have a plan, an insurance plan for your investments. Particularly for those of us who invest in business ventures. One of the things you should do is sign up for an insurance package. There are a lot of insurance companies in Nigeria. I'm not mentioning names. We are not advertising anyone here. But seek out a good insurance company. Insure your investments. Very, very important. It's a very important part of risk mitigation when you are investing. Insurance is very fundamental. Whether it's burglary, for those of you that have business premises, fire, financial loss, there are all kinds of premiums, insurance premiums they are called. All right, to get some insurance. And then the last part of your financial planning must involve goal setting. And we've talked about goal setting in one of our sessions. You can join our Telegram group and look up all the videos we have done. We've done quite a number of videos. And in one of those sessions, we talked extensively about goal setting. Your goals have to be smart. All right. So if you want to learn more about what we said about goal setting, please go and look at that video. All right. So the next important part of investment planning is financial planning. All right. So you need to have a financial plan. You need to have a financial plan. You need to tell yourself, these investment decisions I want to make now, this is how much money I want to be making out of this investment. So I'm putting in 200,000 naira. I am hoping that in 2 years, this 200,000 naira would have multiplied or appreciated to about 300,000 naira or 400,000 naira or 1 million naira. All right. And then the question to ask yourself is, if it's 200,000 naira I have and I want to grow it to 1 million naira in 2 years, what kind of investment vehicles will guarantee me that kind of rate of return? I hope you understand what I'm saying. It's not enough to say I have 200,000 naira and I want to grow my income. That's a very, very shallow way to invest. You need to have a solid plan. I'm investing 200,000 naira. I'm hopeful that in 2 years, in 3 years, this 200,000 naira would have appreciated to 1 million naira. So the next question is, what investment vehicles give me such advantages? And I can give you a few examples right away. If you invest in stocks, you have a chance. You have a chance, depending on the growth prospects of the company you're investing in. You can grow your income to that level if you invest in stocks. Number two, if you invest in agricultural products, in commodities, your income can grow to that level. Agricultural products are products that can appreciate in value by 1,000%. Somebody calls it blood money. All right. So these are just a few examples. And a business, you can start a business. It can grow your income fivefold in 2 years. Very, very possible. Even more than that. Okay. So you need to have a financial plan. The second thing I want to say about financial planning is you need to have your financial priorities well articulated. All right. So do you want to become rich, or do you want to be comfortable, or do you want to just be secure? You need to ask yourself those critical questions. What are my priorities for investing? Do I want to become rich? Do I want to become wealthy? Do I want to just be comfortable, want a comfortable life? Or do I want to just be financially secure? Just okay. So you need to determine that. Your plan is useless if you don't follow it. All right. So the next thing I'm going to say is, having drawn this plan, having written out your goals, the things you want to achieve, whether you want to become rich, you want to become comfortable, you want to become secure, that plan, you need to follow it through. All right. Don't forget that what is written and not acted upon will remain on paper. Your plans should not remain on paper. Your plans should be executed. All right. It's your financial, it's your roadmap to financial success as an investor. Now, I want to quickly look at another class of investors as we begin to get to the end of this conversation. You have about five categorizations of investors, and I'll look at them very quickly. We have what is called the accredited investor. I mentioned that in passing previously. An accredited investor is someone that earns a lot of money and is a high net worth individual. All right. These are investors that have understood the game of investing. They have become very versed and versatile. They know how to invest in the stock market. They know how to do what is called profit taking. The company is about to publish their financial year end results. They know when to buy the shares, put in their money, and just to be eligible to be partakers of the dividends. And then when those companies have announced their dividends, they do what is called profit taking. They take their profits, they move their money away, and they go somewhere else. They know, they understand the trends, all right? They know how to do real estate. They know how to determine if this property is genuine, if this property is fake, if the documents are fake, if the documents are not standard documents. Okay, this is an accredited investor. Now the question is, many of us out here, I believe you're not yet an accredited investor. So don't worry. That's why TWI is here. We hope that in a few weeks of this series and this engagement, you will begin to grow in your progress towards becoming an accredited investor. But one thing to say about this is that you don't become an accredited investor just by what you know. Accredited investors are those who know so much, have done so much, and have earned so much. All right. So they know so much, they've done so much, and they have earned so much. So knowing is just the first step of becoming an accredited investor. Now, the next class of investors I want to talk about are the qualified investors. All right. They have the fundamental knowledge. They have the technical knowledge. They understand all the terms of the stock market. They understand debentures. They understand futures. They understand securities. They understand sukuk. They understand investment funds. They understand all the terminologies, right? They are qualified investors. All right. They know the nitty gritty. But you see, being a qualified investor is okay. Knowing so much is okay. But you see, that's not where you're supposed to stop. The next class are the sophisticated investors. All right. Very sophisticated. They understand the law. They understand investing. All right. Are you sophisticated? Do you know about investment? Do you understand the legal dimensions of investment? You want to buy a property. Do you understand the legal implications of not having a C of O? For instance, let me give you an example of what I'm talking about. I was going to buy a property in Abuja, and it looked very nice. The price looked very okay. Very strategically located, plot of land along Airport Road, very well situated. Um, but thank God I had some level of sophistry. So when they sent me the papers, I understood that in Abuja particularly, you need to be very sure about your land titles. And so by virtue of my quest for knowledge in investment, I had made inroads into the Federal Capital Development Authority, FCDA. So I had people there. So I sent those documents to them, soft copies, and they raised the red flag immediately. These papers are not from our office. All right. And I was able to save myself from losing money. Now, someone who is not sophisticated would have fallen into the trap because of the fineness of the property and because of the papers that were presented. Now, people can fake papers. People can, go to any printing press and forge signatures and do all kinds of things. So the sophisticated investor understands investing, understands the legal dimensions of investing. The next important class is the inside investor. The inside investor creates the investment. Now, when we talk about the inside investor, we're talking about people who start businesses, okay? The inside investor is someone that starts the business, all right? He starts a company, grows the company, makes it a going concern, makes it profitable, makes it a desirable company, all right? Finally, I'll talk about the ultimate investor. The ultimate investor is the investor that has not just grown the company, has not just made it a beautiful bride that everybody wants to court. The ultimate investor brings that company to the public. Usually, he starts via what you call private placements first. I remember Jim Ovia of Zenith Bank. Jim Ovia is an example of an ultimate investor. Before the consolidation exercise happened, Zenith Bank had some investors, some inside investors, people who bought into the company even before the general public had access to the company via private placements. All right, they're called private placements. Big investors, sometimes institutional investors, who identify a brand, who identify a successful company, and they want to have a share of that company, and they approach the owners of the company and say, want to be part of what you're doing. And then the terms are reached, and then they come to a point where they sign the papers, they put the money in there, and they start earning a certain measure of reward when the company makes money, before the company now goes public, all right? Where the public, so it moves from being a private limited liability company to being a public liability company, a PLC, or if you like, a quoted company, a company that's quoted on the stock market. Another class of investors I want to talk about are the angel investors. An angel investor is someone that invests in a startup company, a small company, and usually he invests in the company when the company has not yet become a very big company, and then he, or when we talk about angel investors, it can be an individual, it can be an institutional investment company, right? They invest in those companies and help them to achieve their financial objectives, and they usually own a stake in that company, all right? Angel investors usually want equity, all right? They own a stake in that company. They might sell the stake later on, all right? And that's what distinguishes them from venture capital companies. Venture capital companies are also, they're sort of investor. They invest in startups as well. However, venture capital companies, usually, now the difference between an angel investor and a venture capital company, angel investors usually do not take part in the running of the business, all right? They just put their money, they get their returns, they get some measure of control, they own equity in the startup, and they don't usually get involved in the running of the business. Venture capital companies usually get involved in management decisions and stuff like that. And usually they pull out their investments after a while when they feel their objectives have been achieved. So these are a few classes of investors we want to talk about. Some facts about investing. I want to just say a few facts about investing. Investing is as risky as the investor. There's Robert Kiyosaki that says investing is not risky. It is the investor that is risky. All right. So investing is as risky, and investment is as risky as the person investing. All right. So if I am not knowledgeable about land titles, if I'm not knowledgeable about how securing CFOs, securing the proper titles are concerned, if I go investing in real estate in Abuja, for instance, if I don't have the knowledge, I have the money, but I don't have the knowledge, then the investment is risky because I don't have the knowledge. I don't have the contacts to authenticate the necessary documents I need to authenticate. So investing is as risky as the investor. The second point to note is that investing is a journey, it's not a sprint. All right, and that's where planning comes in, and that's where style comes in. So you can be short term as an investor, but have a long term plan. All right. When we say short term, meaning that the length of time to which you are willing to commit money can be short, but you're staying on that course for a very long time. All right. Investing is a journey, not a sprint. I think that should be noted. Then those who win with investment are those with the right knowledge. Those who succeed in investment are those with the right knowledge. Do you have the right knowledge about investing? Investing is not rocket science. The last thing I want to say, investing is not rocket science. It can be learned. It's like art. You can grow in your knowledge. You can grow in your expertise. You can grow in your ability to make smart investment decisions. All right. Now, want to now go into the subject matter proper. So we'll be dealing with stocks, capital markets, money market instruments. We're dealing with real estate. We're dealing with investments in commodities. We're dealing with being an inside investor, growing a business, starting a business, and growing a business. All right. We'll be doing a lot on the equities market. Equities are called stocks. For instance, the equities are regulated by the NGX. The NGX is Nigerian Exchange Limited. It's a limited liability company that that holds and controls the Nigerian Stock Exchange. It used to be the Nigerian Stock Exchange, NSC, but recently it was privatized and changed to NGX Limited. It is regulated by the Securities and Exchange Commission. All right. For the investment in stocks, there are certain key stakeholders that are involved. I'm going to mention a few of them. You have the stockbrokers, you have the registrars, you have the issuing houses, all right, you have the regulators themselves. If you want to know about this and much more, then join us in the next part of this series, the Investors and Investment Masterclass. We're going to go right into the details of investing in stocks. Some of you have been wondering, all these shares thing they say, buy shares, sell shares, how does it work? How do I get into that space? How do I know which shares to buy? How do I know which stocks to buy? And all of that. Or some of you are worried about real estate. How do I determine if this property is right or this property is wrong for me? Or commodities, which commodities do I buy? Where is the market? Where do I buy these commodities at very good prices? How do I do the storage? So if you want to be a part of this great investment success story, then be a part of our next session. I made reference to a couple of things during the course of this session. I talked about setting smart goals. If you go to the link in the description below to take you to our Telegram channel, all the comments I cited from our previous sessions, if you follow the link in the description below, it will take you to our Telegram channel so you can have access to tremendous resources, eye-opening resources, resources that will change your financial outlook. All right. Our goal in TWI is to make you better financially. And the good news about this is that it's absolutely free. You don't pay a cover for any of these things. All right. And so we also like to know how much you have learned from the session tonight. We want to know how much you have learned about investors, about investing so far. So far, today is just a preamble. We have laid the groundwork for our understanding of the next phase of this journey. So we'd like to know how much this means to you. Please drop your comments in the comment section below. Drop your comments in the comment sections below. And then if you feel this video has been valuable to you, we'd like you to share this video to your friends, invite them to the masterclass on this channel, on this YouTube channel. It's TWI channel on YouTube. You can also use the description, like I said earlier, to go to our Telegram channel. There's a lot of information there. The previous engagements we've had has been very tremendous. The feedback we've gotten from participants has been mind-blowing. You don't want to miss out of any of those pieces of information. And so thank you. We'd love to get your feedback. Please drop your questions, drop your comments, drop your queries. If there are things we said you're not very clear about, please drop your questions, your queries, your inquiries in the comment section. The last thing I will say before we say goodbye tonight is we also offer a peer group kind of investment system. What do I mean by that? You can be a part of 1 or 2, 3 persons who have a certain interest, whom you can jointly invest with. All right. And we also give you coaching services. We do mentoring services. Peradventure, you want to invest in business, you want to set up a business, or you want to go into stock trading or other kinds of investing, please contact us. We'll be there to guide you and be there to help you. All right. So thank you and have a good evening until we see you next time. Thank you.